Valuing an American option using binomial tree. In a previous post, we provided an example of pricing American options using an analytical approximation. Such a pricing model is fast and accurate enough for risk management purposes. However, sometimes more accurate results are required. For this purpose, the binomial, lattice, model can be used. Wikipedia describes the binomial tree model as follows. In finance, the binomial options pricing model provides a generalizable numerical method for the valuation of options. The binomial model was first proposed by Cox, Ross and Rubinstein in 1979. Essentially, the model uses a discrete-time, lattice-based, model of the varying price over time of the underlying financial instrument. The binomial pricing model traces the evolution of the option's key underlying variables in discrete time. This is done by means of a binomial lattice, tree, for a number of time steps between the valuation and expiration dates. Each node in the lattice represents a possible price of the underlying at a given point in time. Valuation is performed iteratively, starting at each of the final nodes, those that may be reached at the time of expiration, and then working backwards through the tree towards the first node, valuation date. The value computed at each stage is the value of the option at that point in time. We utilized the lattice model previously to price convertible bonds. In this post, we're going to use it to value an American equity option. We use the same input parameters as in the previous example. They are volatility. In this example we are going to use historical volatility. We retrieve the historical stock data from Yahoo Finance. We then proceed to calculate the daily returns and use them to determine the annual volatility. The resulting volatility is 43%. Detailed calculation is provided in the accompanying Excel workbook. Stock price. The stock price is also obtained from Yahoo Finance. It is 13.5 as of the valuation date, August 22, 2018. Dividend. The dividend yield is obtained from Yahoo Finance. It is 1.2%. Note that for illustration purposes we use continuous instead of discrete dividend. Interest rate. The risk-free interest rate is retrieved from Bank of Canada website. Since the tenor of the option is 3 years, we're going to use the 3-year benchmark yield. It is 2.13% as at the valuation date. Using our Excel workbook, we obtain a price of $3.30, which is smaller than the price determined by the analytical approximation, Barone and Desi-Whaley, approach. Go to our website to download the Excel file.